Welcome to today's seminar, Forecasting the Year Ahead, What Changes to Expect in the Cost of Production, the Weather and the Markets in the Near Future. My name is Ian Thomas and I work for AusVeg as a project officer running the annual vegetable industry seminars. While we've had people from all over Australia register for today's event, I'm joining you from the lands of the Wurundjeri people of the Kulin Nations. I wish to acknowledge them as the traditional owners of this land and that their sovereignty was never ceded. I would like to pay my respects to their elders past, present and emerging. From wherever you are joining us today, AusVeg would like to acknowledge the traditional owners of your lands and pay the same respects to those communities and their elders. Obviously, it's impossible to predict the future, but having access to predictive tools and the latest data in formats tailored to your business's requirements can help you make the best possible decisions when planning for the coming year. Forewarned is forearmed is the name of the game today. So in that spirit, we've organised 3 presentations focusing on different streams of data and the resources available for you to access them. James Parry from Freshlogic will present on what's been happening with the vegetable price of vegetables over the last little while. Rachel Davis from the Bureau of Meteorology will present on resources currently available to you and what not might be coming online in the near future. Andrew Whitelaw from episode 3 will give us an overview of the factors that have been affecting the cost of inputs over the last year or two. If you have any questions during the presentations, please ask them using the Q&A tab at the bottom of your screen. And we'll answer all of these as a panel at the end. After this, a short survey will pop up on your screen and we'd be grateful if you could fill it out. The results from this survey will be used to inform the topics for the annual vegetable industry seminars for next year. This series of webinars has been funded through Hort Innovations Vegetable Fund. First up, we have James Parry, the Business Development Manager for Freshlogic. James is responsible for connecting horticulture industry stakeholders with decision-ready insights. Drawing from experience working with producers and wholesalers, he identifies the trends and influences driving horticultural markets. James is going to take us through what's been happening with fresh vegetable markets over the last little while. Take it away, James.
Thanks, Ian, and thanks for everybody for showing up today. I'll just go through and share my screen now. And so as Ian was saying, sort of graciously brought me on to talk about some of the things we've been seeing across vegetable consumption price, along with some of the influences that have sort of been affecting vegetables and their markets. So today I'd like to talk about some of the market settings that are shaping vegetable pricing, some of the ways that the market is sort of shaped from supply right through. Some of the challenges we've been having this year, make note of them, along with how that's affected the markets themselves, from sort of price inflation that we've been seeing through to how that's affected volumes and recovery and pricing. We've been seeing a little bit for the start of this call. Additionally, we'd also like to talk about some of the things that have been popping up and we think will play a bit of a role going forward, including an elevated consumer value focus, some of the changes to food service we've been seeing here, and the online channel for fruit and vegetable shopping. So basically, I've seen that this is a bit of a feature, and I've been told that you're meant to say a little bit about yourself. So as Ian was talking about, so my name is James Parry and I'm Business Development Manager for Freshlogic. So originally I was born on a beef and sheep property in South Gippsland, and after being there for a few years, it wasn't quite the speed I was hoping for, and moved to the big city. After which time, after studying food science, I ended up in horticulture. So, decided I didn't want a career in beef getting up at 5 a.m. and ended up getting up at 5 a.m. to go to the Melbourne markets in the morning for my first job. Since then, I haven't really looked back. I mean, worked with wholesale producers across the country, most recently with Parry Fresh, working with fruit and vegetable supply chains, particularly in the northern part of Australia. So a little bit more about the business. So Freshlogic is a fruit market research and analytics business. We specialise in horticulture. We provide data and insights to stakeholders at all levels, producers, marketers, input providers, all the way through to financial institutions, government and PIBs. You might know us from our largest project, the Hort Stats Handbook, which comes out in January every year. And I'm really looking forward to delivering that again for 80 plus PIBs and categories. Our approach has always been that fruit and vegetables are short life perishable products. So our approach is that we add it all up. We'll basically capture and align volumes and values from supply through all the distribution channels to consumption, because given the dynamic nature of fruit and veg, we think this is the only way to make sure that you really are across the entire industry. We also supply data and insights ready for decision makers. So part of that is that we're ready to deliver for your business without the need for a ton of analytic resource. Before I start talking about how we've gone for the year and some of the things that have been challenging for the season so far, so let's start with some of the market settings that shape vegetable pricing. The first of those I just mentioned is that vegetables and all horticultural products are short life. They don't last long, and you really need to move them quickly. Puts a lot of time pressure on those decisions and makes sure that those things are dynamic. And the second is it's pretty unique. Australia supplies its own produce. So this is probably only the same as a few other markets around the world. You might see it in Italy, Spain, some South American countries, but it's a little bit of a contrast to what we've been seeing across developed markets, where a majority of the product is imported. Generally, you don't import an oversupply or an undersupply. You just import what you need. Here in Australia, we put together our production by a remarkable level of productional regional diversity, and that sort of allows for year-round production, which is no mean feat. But it also has the caveat that disruptions to that supply can also cause market shortfalls or oversupply during that time. And unfortunately, that's been the story of 2022. Obviously, we've had severe weather events and just generally wet, cool conditions that have really not helped production and caused losses from, and that's been pretty much everywhere up and down the East Coast, from Bairnsdale to Bowen, really. Also preventing replanting and have really affected that winter, but particularly the winter Queensland supply period. Additionally, labour availability has been a serious and ongoing issue. At last count in September, we were still down 170,000 workers, according to the National Farmers Federation, which is pretty serious, even with a bit of a bump now that borders are open and people are coming back in. Additionally, we're also having issues with rising input costs, fuel, fertiliser, these sort of things, which have really been affected by the geopolitical and supply chain logistics sort of issues that we've been having worldwide. And these have all led to reduced production. And that sort of brought prices up, which I'm sure everybody is more than knowing at this point, as it also sort of produced a bit of a fascination with iceberg lettuce, which I don't know about you. That's for the first time it's happened for the humble lettuce in my existence. So something a bit interesting there. Going to what's actually happened in the markets themselves, what we've seen is a level of price inflation, and the best place to sort of track that is, in my opinion, the wholesale market. Generally, that's where the product is moved around, particularly for under and over supplies, and that's probably the best indicator that we can see for the level of supply here, and it tells a really stark picture for the September quarter. So what you can see here on this graph is the weighted sale price versus last year, and change on the September quarter. So for total veg, this was up 38% across all vegetable categories, with all vegetable and potato categories being affected, except for ginger, zucchinis, and sweet potato. What you can also see here in the line are some of the categories that have been most affected by flooding. So it probably goes to show that that supply demand relationship is unfortunately probably driving things a bit more than, say, the cost of production that's really sort of been affecting producers more recently. Now, going on from that, we've also seen changes to retail volumes. So unfortunately, that sort of flowed on. While there's always a level of ability to cope with some of these supply issues. For the September quarter, we did see a reduction in 9.3%, or around about 40,000 tonnes of product from the September quarter this year, from the September quarter last year. And that's following on from the March and June quarters that were down 6.23% and 5.41% respectively. We have seen some recovery in that so far. I mean, for the December quarter, we have gone from a price of around about, for retail, that is, retail listed prices have gone from an average $8.39 a kilo, which is 17% higher, and have really eased back to around about $8, which is around that sort of 5% mark more than last year. So there has been some recovery now that we're getting southern season product. The end of the Queensland winter season has sort of produced a little bit more with some warmer temperatures and less rain. So there is a little bit of optimism there. In saying that, if these are the market settings, where are vegetable markets going? And while we have seen a bit of recovery, I guess it's probably hard to tell exactly where you are with forecasts, with a lot of the disruption and uncertainty set to continue. It doesn't sound like we're going to go back to pre-COVID levels for our labour or input prices for any time but to come. And additionally, the big one there would be the La Nina cycle is set to continue for a more time. We are, though, seeing a number of key trends across retail there, which I'd like to show you from here on. The first of which being a consumer value focus. So as we were talking about with the lettuce example, inflationary concerns are really starting to sort of dominate the discussions. That cost of pressure for household and businesses is becoming quite real. And you can see that in the CPI per quarter, where we reached a level we haven't seen for 30 years, with CPI of all groups at 7.3% and food and non-alcoholic beverages at around about 9.6%. Fruit and veg in this were probably a big contributor at around about 17.4% for the September month. And as anyone's aware, this has prompted the 6 successive RBA cash rate rises from April, which is really significant. You know, we're up to 2.85% now, and this is putting a real pressure on the 35% of households with mortgages, which are seeing, you know, their repayments go up for no extra product. You can sort of see this in weekly household expenditure. So from the food and grocery expenditure on average for households, from our Meal Pulse panel, what we've seen is a weekly household shop going from $263 in March 22 through to $283 in September 22. And then that 6-month period, that's about a $20 change. Contrast that with, say, if you took out the average loan in March of 611,000, your repayments would have started at 626 and would have jumped through to September to $774. So that's a change of $150, which which comes out to about 52% of the household food spend. So as I was saying, that doesn't put any more product on the table, doesn't buy you anything else. It just puts more strain on your spend household level. So that, we're probably likely to see an elevated level of value sensitivity from consumers. And also, this is likely to lead to more competitions from retailers who want to be seen as a discounter in this sort of market. Now, given that's the case, I know personally, I was looking at this inflation number running rampant, and my initial thought would be that people would stop buying and going out, particularly to buy food, and the food service would take a bit of a hit. And I was certainly wrong on that point when we started crunching the numbers, that's for sure. Food service now in the last couple of months is actually higher than pre-pandemic levels. So as you can see in the chart here to the right, the value of the food service sector over the last 2 months has actually peaked over 5 million, which is certainly quite a bit higher than what we were seeing at the 4 million mark prior to COVID. So really a lot of strength there in the sector, and that represents about 458,000 tonnes for the year ending September 22. That's 19% of the fresh market volume, and that's 1.2% more than we saw last year. So I think it sort of confirms that eating out of home is something culturally that we're going to see more. And yeah, I think that's going to be something that we'll continue to see in terms of volume and value throughput for vegetable as a sales channel. So additionally, during that COVID period, we did see some movement, particularly in online shopping. After a period where the growth was just bonkers, we saw levels jump to 222 million in sales for quarterly fruit and veg in September last year, while the country was still in lockdown. That was a food that basically reached food and grocery share of 10.3%, or about $10.3 million all up. That was less than what we saw overseas, where the share achieved in the US, UK, some of these other developed markets hit about 14 to 15% at their peak, but it's still really meaningful. This came back a little bit during the year, but it looks like it's stabilized now that we're sort of out of lockdown, and you can sort of see that we've hit about stabilized around about 8.8% of total food and grocery sales. Well, you can see that there's a change from 175 million in Q2 this year to 205. Some of that's padded out by inflation. So even keep taking that into account, it looks like this is where food and grocery is probably going to be from here on. And that says some really important things too. So with every purchase at online being worth 3 in terms of value, this is really going to reduce the amount of household shopping trips overall. And given that the $200 million sales figure is around about the same as 200 full-service stores, this is probably going to affect and has been affecting retailer spend in terms of investment. We haven't really seen the investment in new stores, and retailers have been spending pretty big on working out how they're going to distribute this product so it works better. So keeping that in mind, product development for vegetables should probably keep this in mind, that we need to make sure that we've got product forms that really fit this channel. Now, in saying that, that's pretty much all from me. Might just check if anybody's got any questions to that.
We've got a couple, James, but I'll do them at the end.
Sure, no problem.
All right, thank you. Thank you so much for that presentation, James. It's very, very interesting. You don't sort of see those kind of stats broken down that way very often, in at least in my line of work. Coming up next, we've got Rachel Davies. Rachel Davies is a certified practicing agriculturalist with private sector experience in horticultural supply chains. Rachel currently leads the Bureau of Meteorology's efforts to support Australian horticulture, sugar and wine industries. She's currently focusing on building the Bureau's relationships across the horticultural sector in Australia. And in that spirit, she's going to take us through some forecasting tools currently published by the Bureau, and talk a little about what might be coming on in the near future. Take it away, Rachel.
Thanks, Ian, and afternoon, everyone. Just trying to actually work out if it's afternoon everywhere, but probably not yet. I'll just share my screen. There we go. I'm just seeing out if you can't see that. So yeah, thank you for the introduction. One of my hats is I work for the Bureau of Meteorology, and my role is to engage with industry and feed back, agriculture industry, and feed that back to our scientists and technical people to tailor our products and services for industry. So I'm based out of Brisbane and Yugara and Turrbal country. And just the presentation I'm doing today, I'm going to be talking about why am I here, why are agriculture programs here, how will we do what we want to do, what are we doing, what's next, a little bit of a 3 things you need to know, and we'll finish with a bit of an outlook for the upcoming summer. So the agriculture program is here at the Bureau of Meteorology to generate more than $300 million in new economic and social value per annum for the ag sector. And so the idea is this will significantly contribute to the $100 billion value target by 2030 that's spruced around the place. So how will we do it? I mentioned we've got a few agriculture leads. So I look after horticulture, sugar and wine. And we've got a picture earlier was other team members in our agriculture team. We're trying to cover all of the agriculture sector. So yeah, engage with industry and tailor our products accordingly. So that's our aim for how we will do it. How we reach that target. Yeah, this is just a bit of about how we're broken up within our customer team. And yeah, we have customer leads covering off all those sectors, and noting as well that typically a previous focus in the agriculture program at the Bureau of Meteorology was only on production. And we note that obviously it's not the only cog in the wheel. And so we're trying to make sure we cover off as secondary focuses the rest of the supply chain and value chain in agriculture. And because of my previous experience, and I still do a bit of work there, 20 years in the wholesale markets, wholesaling organic fruit and veg. I'm covering off the supply chain space in wholesalers, retailers, and logistics. So a bit about what we're doing at the moment. There's a project called Climate Services for Agriculture, and that's still in development phase, a platform looking at the long-term risks for your region and commodity. And so you can really drill down and look at more of a longer term risks there on that platform. So I've got an example here of, I think this is actually, out of near Hobart, a future spring frost risk with apples. So it really does look at that longer term. Wouldn't be a tool you'd look at every day, but yeah, maybe some, it's being used by some for like longer investment and infrastructure development. Another big project is the Agri-Climate Outlooks project. Actually, Agriculture Innovation Australia just had, I think, media release this morning announcing that large investment. We've got 10 RDCs on board, and Hort Innovation is one of them, committing investment from the vegetable funds into a couple of sub-projects out of that bigger project. But that's really looking at the seasonal decisions and how we can have some agriculture meteorologists basically is one of the work streams, and how we can help add impact and value to those seasonal outlooks and with the agriculture lens. Another project at the moment released in product form, ObsCheck. So I've noted that there's probably about 20,000 private automatic weather stations around Australia, and how we can use them in the bigger network. And it's putting those private automatic weather stations into the system by like a quality check, and having that with local automatic weather stations and our gridded data. So a little bit about this was an example I heard in the almond industry was they stopped getting frost insurance because the insurance guys would just go like tap into their computer and look up that observations on the Bureau of Meteorology website indicated that farmer didn't get a frost at their location, but the automatic weather station's about 50 kilometres down the road. And so this is bringing in observations on site and trusted. So it's a quality check system that the insurance companies are going to use, and there's many more benefits to that as well. So what's next? We've recognised that there's some key priorities that we'd like to focus on with the agriculture industry, and in particular improving our products and services. Temperature extremes is a focus. Biosecurity, that's another focus of mine. We've split these up with our customer leads. And how can water, weather and climate play a role in forecasting potential pest and disease risks, and having that link in there. 0 to 30-day seamless rainfall forecast is another key priority we've noted. So the Bureau does like 0 to 2 day really well. We've got out to 7 days, and then we've got a climate outlooks, and they all use different, for various reasons, they all use different models, and it's about needing that a bit of a seamless forecast, so it's not clunky between looking out from now to in a couple of weeks' time. And interpretable forecasts. So our goal is to have more than 80% of agriculture users be able to interpret the forecast. We're noting that the forecasts can be displayed in not clear, easy messaging, and how we can, improve that user experience and make sure people are understanding. Like, it's all well and good to have these forecasts and levels of accuracy within them, but we don't want that gap to be misinterpretability. So some other key focuses of ours. So I thought I'd go into 3 things you need to know following on from interpretable forecasts. I've included some examples here of how the forecast is displayed on the BOM website. And so a big misconception, and it's how it is displayed, is that there's I've heard there's some people, and I had this as well before I started this year, that this could be read as 70% chance of 1 to 10 millimeters. Now that's not correct. The correct interpretation is that there's a 70% chance of any rain, which is registered at 0.2 millimeters, because I think that was the old tipping bucket, and that the possible rainfall is that there's a 25% chance of at least 10 millimeters and a 50% chance of 1 millimeter. So confusing, right? And also our mobile app has recently been updated, and that's also interpreted differently there as well. So the upper value is the 25% chance, and the lower value is actually a 75% chance. But what I really like about the mobile app now is that you can there's like little eye buttons and little information buttons, and you can go and select which chance you'd like to look at, as well as it just explains what the 7-day rainfall forecast is showing. The website, we're going through another upgrade of that, so it's probably going to be a little bit longer to make that interpretable better, but there's just something to be aware of. When you're looking at climate outlooks, I just wanted to reiterate about when you're interpreting the seasonal forecasts, it's always important to, looking at this map of chance of exceeding average rainfall, it's always important to use the skill map and past accuracy to determine, I guess, how much weight do you put in this outlook and decisions that you're making because of this outlook. So here where the star is, we've got a 30 to 35% chance of exceeding median rainfall during this previous March to May period. And then, but how much weight do we put on that? And so the map on the right there in dark green, we've got a 75% accuracy, more than 75% accuracy for that forecast at that time of year for that region. And so probably put a bit more weight into making decisions about a lower chance of exceeding average rainfall. And at this cross-border location here in the triangle, we just don't have as much skill and accuracy at that time of year for that forecast for that area. So whether that be certain climate drivers at the time, gaps in automatic weather stations, which I reckon the OBSCheck product in Utopia is hopefully going to improve. And yeah, so you probably wouldn't put as much weight in a decision where there's no skill. So this slide's more just a reminder, I guess, just that when looking at seasonal outlooks, you should always, use the skill map as well. So every farm anywhere in the country. So we've got the Australian Water Outlook page, which has 100 years of historical data looking at soil moisture, rainfall and evapotranspiration. And we also have now included in that forecast for soil moisture. And so you can look at the upcoming area for your location. We've got 7-day forecast from Medeye, that middle screenshot there. So you can actually save your location and it can go out 3-hourly blocks for the next 7 days. And similar to what I was showing before, this is where you can get your seasonal outlooks, also called climate outlooks, also recently changed to calling long range forecasts, just so we have that seamless forecast from 0 to out to 1 week, 2 week, monthly, and then 3 monthly. So yeah, some great tools there. These are links as well highlighted here. So afterwards you can go have a play and have a look on these websites. Okay, I thought should probably do a bit of an outlook today. I'm certainly no meteorologist or climatologist. So I've grabbed these from the publicly available websites and thought I'd do a bit of a summary for December to February. So we've got the rainfall map there. The bluer indication is clear that's likely to be above average for rainfall for most of the eastern states for December to February, and likely below average for large parts of the interior of WA. Temperature-wise, days are likely to be warmer than average in that redder part on the middle map there, and minimum temperatures are actually expecting warmer than average nights for December to February in those darker red areas. And once again, just always drawing your eyes back to those green skill maps and a bit about how much accuracy we're looking at putting behind those forecasts. So this outlook, with this wetter outlook, is consistent with several climate drivers at the moment. So La Nina is active at the moment, but the models are showing indication that may weaken in 2023. And another factor at the moment is a negative Indian Ocean dipole, which typically does bring more rainfall in those areas seen, and what we've seen already over the last few months. That's showing a weakening, and so that probably an assessment on that in a couple of weeks, whether that is Indian Ocean dipole is removed from being active. Another factor probably to this outlook is the southern annular mode, commonly known as the SAM, and a positive phase of the SAM pushes up and expects to see that wetter outlook on those eastern states. Thought I'd cover off a bit of a soil moisture outlook. So this you can look at from the Australian Water Outlook website. So soil moisture is expected to be high for much of Eastern Australia and Tassie during the summer period, and in the north, soil moistures as the monsoon sets in. We're naturally expecting wetter up there. So I guess also to note, soils are already saturated, so probably to add in a little bit to the outlook previously, that even though we are expecting for some climate drivers and this outlook for rainfall to maybe reduce from the January months, any rainfall would be impactful because of the wetter conditions we've already had. So still chance of flooding. I thought, giving you a bit of a broad outlook there, but it's really important, I think, to take information for your location and region, and having a broad outlook like that, while it's cool for some, key messages, so good to hear for some key messages, but it's still really important to look at your area and what's going on in your area for the forecast. So I've picked Wayne and Tash Shields' property here down on the Mornington Peninsula, who grow some organic veggies. So using that Climate Outlook's website, you can drill into chance of above average rainfall, and drilling in here, we've got, for this area, we've got a moderate chance of exceeding average rainfall for this outlook for that location. And there's a lot of other selections you can do on that outlook page, and recently through the forewarned is forearmed investment, there's more products that have come out there which could be really useful. So I encourage everyone to have a look there. I'll just flick through these, but just wanted to cover off, this is some of the stuff you can look at, chance of extremes, and then dragging into some graphs here. And for those that are a little bit more climate savvy, might want to look at some of this climograms as well. So yeah, information there for Baxter. And similarly, you can look at some chance of unusually warm overnight temperatures and unusually warm maximum temperatures. That just goes back with that chance of extremes option through that. So I ran through those last slides pretty quickly, noting time, but yeah, that's the end of my presentation, and yeah, happy to take questions at the end. Cheers.
Thank you, Rachel. I certainly know as someone who's had to use the BOM a lot managing properties over the years, it's always good to get a refresher on what everything actually means, as we can tend to get a little narrow-minded on the bits that we use and forget the others.
No, cool. And I did just want to add, just to anyone that does want to reach out, agriculture@bom.gov.au, that last slide, for an email address there. So cheers.
Fantastic. Our final presenter today is Andrew Whitelaw. Andrew started his career in the United Kingdom working in the animal feed and biofuel sector before relocating to Australia. He gained an undergraduate degree in business IT, majoring in e-business from the University of Western Scotland, and during his time in Australia has earned a master's degree in agribusiness from the University of Queensland. Since 2010, Andrew has worked in the Australian grains industry in a number of different roles, from grain trader to pig farmer, and most recently as an independent analyst. In his spare time, Andrew runs a podcast on agriculture called Ag Watchers, with his fellow episode 3 co-owner Matt Dalgleish. Today, he'll be presenting on the factors that have been affecting cost of inputs. Take it away, Andrew.
Righto, thanks very much for having me. Oops, bear with me. Righto, so just to give you a bit of a background into who we are, we were formerly known as Thomas Elder Markets before purchasing the business in September and rebranding to episode 3. We focus very similar to Freshlogic. We do a lot of economic analysis on markets, largely with focus on broadacre commodities, cereals, oilseeds, and livestock and fibers, but also food. We have a lot of complimentary articles on our website, episode 3.net. But we also do a lot of bespoke work for clients, whether it's investments or just standard sort of economic analysis of market fluctuations. I thought I'd put in a bit about who I am. I've got a background in commodity markets. I started my career actually in the animal feed industry in the UK and Europe. My background was in computer science, followed by studying agribusiness. Experience in the UK, Europe, and Australia. And I'm also a former commercial pig farmer, and which I got out of a couple of months ago. And I'll talk a little bit about that later on. So what I want to do to talk about today is what is driving input costs. And we'll be looking at a lot of chemicals, fertilizer, fuel, labor, because they are the main ones that are going to be a large cost, whether you're a broadacre farmer or whether you are a horticultural and veg producer. So I'm just going to jump straight into it because I want to get it through so we can get on to the questions. But talk a bit about what's driven fertilizer markets over the last 18 months. We are seeing extremely high prices, but where it all comes down to when it comes to fertilizer, and most of agriculture really can be brought down to its base component. And to us, we believe the base component to agriculture is not necessarily rain, it's energy. And what we've seen over the last 12 months is extremely high natural gas prices. We've seen extremely high coal prices and rising crude oil prices. And if we look at, say, urea as a fertilizer, basically urea is a conversion of natural gas, or in some cases in China, coal into urea. So basically when the gas price has risen, that's flowed through to the fertilizer price. We then had, and what we're seeing a lot more in markets is geopolitical interventions in markets. So we saw in the middle of last year, China opted to effectively ban the exports of fertilizer because they wanted to keep fertilizer within the country to reduce costs locally, encouraging local farmers in China to use fertilizer in the hope of having higher yields to feed their people. Russia enacted very similar quotas on the exports of fertilizer. However, they probably had a bigger impact by the invasion of Ukraine, which has pumped up gas prices. So we're going to have a lot of charts in this spreadsheet, in this PowerPoint, but the charts will be sent to you guys later on, and I think this will be recorded. So if you want a copy of them, that's all good. But if we look at this chart here, this shows the natural gas price basically since 2010. So we can see it basically used to trade around about that 30 euros per megawatt hour. In recent months, we've seen it, this is a monthly average, but we've seen it rising, close to a monthly average of 200. So a massive increase in the price of gas in Europe. It's going to be a very long winter this year, and they're going to be hoping that the weather forecasts stay mild. But if we look at this chart here, this is what I was talking about. If you look at this chart, what we can see is basically a strong correlation between the price of gas and the price of urea. So as gas prices rise, we tend to see urea prices rising. Again, it's basically the conversion of gas to urea. And that's what we'll tend to see is as the gas prices are staying higher for longer, we'll expect fertilizer prices to remain pretty strong for the foreseeable future. And then if we look at glyphosate, which is obviously a very popular chemical, we can see very similar correlations. This is between the US gas price and the glyphosate price since 2006 to present. What we see in this is a very similar pattern of when energy prices rise, we see glyphosate prices rise. We haven't seen the same sort of upward rise that we saw in the middle of the 2000s, but we are still seeing glyphosate prices that are substantially higher than the long-term average. So already we're talking about glyphosate being expensive. We're talking about fertilizers being expensive, down to energy costs. But at the same time, we've also got diesel and petrol costs. We've seen diesel prices spike up in recent times and well above the long-term average. This is a monthly average on this chart. But what is most interesting that we're seeing a lot of nowadays is that the diesel price is substantially higher than the petrol price. And that is a concern going forward because we're talking about typically two commodities that would trade at very similar levels. However, now we've seen an extended period where diesel is pricing itself a lot higher than it previously had been. And we're just seeing higher and higher premiums for diesel over crude. So typically we would be expecting about 70 cents a litre spread between diesel and crude oil. But what we're seeing nowadays is substantially higher than that. And that is a concern going forward because we obviously use a hell of a lot of diesel in all of our operations. At the moment, crude oil prices are starting to come under some pressure globally. However, we're not necessarily seeing that being reflected through to the prices that we receive within Australia. And so that is basically, we are expecting diesel prices to remain pretty strong for some considerable time. There are some concerns from a sovereign risk point of view as well. We store roughly, we've got about 20 days of consumption locally within the country. That is a concern because we have seen a lot of geopolitical activity over the past 18 months. And so there is a concern that if there's any blockages, we've seen blockages caused by COVID, we've seen issues with the Black Sea war. We don't have a lot of stock on hand for if something goes belly up within Australia. So it is a major concern, our fuel security within Australia. And that is something that hopefully the government will be looking at over the next year or so, because they've got some, I believe they've got some research into this area. Interest rates, most of us have all got debt. We are starting to see interest rates rising up. So we're currently, I believe, 2.85%, which is the highest it's been in a long period. But we're still at the low end of the scale in terms of interest rates. So if we look around this chart here, we can see that we're higher than Europe still. There's a lot of the basically developed countries are at a similar level to us. But if we expand it out a bit to how we compare against the rest of the world, we're still at the very bottom end of the range. There's a lot of countries out there that have substantially higher interest rates than us, especially in that sort of developing nations. But what that does is, as our interest rates rise, it does have the potential to have an impact on our Aussie dollar. We tend to find that a higher interest rate will put more value into the dollar as the interest rates differential changes. However, we are still seeing relatively low interest, relatively low FX between the Australian dollar and the US dollar. It has risen in recent weeks, but we are still substantially lower than the long-term average. This is fantastic for exporters. If we are exporting grains or if we're exporting veggies into the rest of the world, which is usually traded in US dollars, it gives us an opportunity to be far more cost competitive. However, the majority of our inputs, whether that's diesel, chemicals, fertilizer, are priced in US dollars. It makes our spending power that little bit less. But I think overall, it's probably still more beneficial to have a low Aussie dollar to help our export market than the hindrance that it causes to our import market. So we are talking about a situation where the US dollar is, they're looking at some more rate rises, and it depends on how quickly we rise compared to the US and how much risk appetite there is for people to hold on to the Aussie dollar. But we shall see how that operates over the next year. As the previous presenter, James, was saying, there is an expectation that there'll be further rate rises in Australia, but they're still relatively low compared to the long-term average. The biggest challenge that we see, the biggest risk that we see in Australian agriculture just now is actually farm labour. I mentioned that I would talk about our pig farm and our experience is that we decided, and largely our biggest reason for selling our pig farm was because of the lack of access to labor. We run this business, plus we have another couple of activities together, my business partner and I, and getting up at 4 o'clock in the morning to load pigs up because the staff have decided to quit is not something that I was looking to do long term. And we were just struggling to get labor, especially since the post-COVID period. So if we look at some of our nations that we've got good relationships with, USA, EU, and UK, what we can see is that unemployment rose quite rapidly during the peak of that COVID during 2020. However, what we're starting to see is unemployment rates around the developed world starting to fall to almost record lows. Realistically, if you want a job, you've got a job now, and everybody who wants a job will have one. And so that's making the competition for workers extremely difficult. Labor works no differently to any other commodity under supply and demand conditions. There's a low supply of workers and there's a high supply of jobs, which is going to mean that if you want workers, you've either got to improve your conditions or pay a big whack more. Part of this is caused by migration. Australia is a migrant nation. If we look at this chart here, we can see that over the course of time, we generally import more people than leave the country. However, 2021 was one of the first years where we actually had more people leaving the country than entered since basically just the post-war period. So that's a very unusual occurrence. So we're effectively losing more staff than we're gaining. And so we need to increase migration and catch up on what we've lost. And if we look across all the different visa types between 2020 and 2021, we had huge drops, whether it was students, whether it was working holiday visas or family visas. We lost a huge number of potential workers. And, that's meant that domestically, we've not been able to fill those jobs. One of the other things that we have is the backpackers, and I'm sure a lot of you guys and girls will be hiring backpackers. When COVID came along, the number of backpackers declined, and so we basically don't have access to that many backpackers, which has caused a decline in available backpacker staff. It's going to take a long time to get those backpackers back up to the old numbers, because if we look back into those backpackers, a lot of them come from Europe, US, and the UK. A lot of them might be jumping into graduate jobs or high-paid jobs because their unemployment rates in their home countries are low, and so they might be deciding not to bother with that backpacking experience. And the other one to look out for in the next couple of years is that the free trade agreement with the UK that was penciled by the previous government, it basically precluded British backpackers from having to do the stint in rural Australia. And so if we look at that as being about 20% of all backpackers, they no longer have to work in a rural area. So if we want those people to work in a rural area, they're no longer, I guess, quote unquote, forced to work in those areas. They've got a choice. They could stay in Sydney, Melbourne, Brisbane, wherever it may be at the beach, instead of going to rural areas. So we're going to have to work harder if we want those British ones to work in rural areas. And that was a big proportion of all the backpackers that we would have. So in a couple of years' time, when that's enacted, the available backpackers to Australian agriculture is going to be quite low. So that was a quick rundown of where we see the input markets over the next year. And I'll just stop sharing my slides. And thanks for having me. And I think if there's any questions.
Thank you for that, Andrew. It was a really fascinating presentation of that data in a sort of macro scale that we don't often get to see tailored to sort of our specific requirements. If I could get all the presenters to turn their cameras, and I'll trust you to do your own microphone maintenance on now. We'll deal with the panel discussion, questions from the audience. First one's from an anonymous attendee. I might rephrase it slightly because they've given us a binary option here. I'm not sure is relevant. During Andrew's presentation, an anonymous attendee asked, what's driving the volume decline? I'm assuming they're talking about total volume of produce.
Yeah, having a look at that one, I think it might be the total volume of retail there. And what we saw was while retailers were chasing value and trying to get people, were going on promotion to try and increase sales during that period through the September quarter last year, this has actually still ended up with a lower volume than the previous year. So, despite the fact that we were in the most heavily lockdown period that Australia was in during that time, we had lockdowns across, Greater Melbourne and Victoria, South Australia, also Sydney for large periods of that too. It was still a lower volume than we had for the previous year, which didn't have that. So, it's hard to say that it's necessarily, all chalked up to that. And I think there is an effect there, but yeah, I'm not sure if that's that's all it chalks up to.
Thanks for that, James. And I'll follow on. Another one came during your presentation by another anonymous attendee. Wholesale vegetable price inflation at 38.4% in September quarter. Was this quarterly rise or annual rise?
This was a quarterly rise. This was the rise for the September quarter itself.
Okay, cool. Thank you. For Rachel, Graham Smith has asked, Rachel, why do we not have radiation sensors at all bomb RAWS sites? So anyone in Australia can estimate real-time plant/crop transpiration rates, water use, and photosynthesis rates growth.
I think that's a good question. Typically, the automatic weather stations are very expensive and typically cover rainfall and temperature, and some other indices and weather factors as well. And so if there is an opportunity that agriculture needs those sensors added, then that's something certainly to look at, and it would require funding and investment from the agriculture industry. But I've already emailed myself that question to delve into it further and provide that feedback to our decision makers. So.
And what was that email address again, if farmers are interested in talking to the bomb?
agriculture@bom.gov.au.
All right. One from Len Ibbotson came in during Andrew's presentation. Is there a risk that by increasing migration, we increase demand for services and goods, therefore exacerbating the problem? Andrew.
Yes and no, I guess, which is a very economist sort of answer to things. But I think, look, we have plenty of jobs. We just don't have the workers to fill them. It does increase services, which can be a good thing. If we have more workers in rural areas, then it increases the number of people in schools, which helps fund those schools and helps maintain places for students in those schools. However, it also, for vegetable producers, it also adds domestic demand into the environment, which effectively, whilst they're workers, they're also providing another outlet for Australian produce. And if there's more demand for those products, then that will invariably increase price. But at the end of the day, we have to have workers to pick plants and also harvest grains. And that is just part of what we've been doing. The problem we've got just now is that we can't facilitate those services because we've had such a big drop in migration over the past 2 to 3 years. And our country is set up for a certain level of migration that's no longer there.
And certainly, in the last year or so, talking to growers a lot of all over Australia, one of the big problems they face beyond any excess demand new workers in their region would have on price or anything like that. It's actually even just finding accommodation for them, finding appropriate housing and services for, keeping them entertained, keeping them transported, keeping them fed and watered, not just the effect their presence has on the market.
And this problem is not something that's exclusive to Australia. If we look at Scotland just now, there's examples of a lot of horticultural products that is getting left in the field because there's no access to labor. And so it is a global problem now, and finding that solution is not going to be an overnight solution.
Thank you very much, Andrew. Another from an anonymous attendee came in towards the end. Are farmers seeing any benefit from the increase in commodity prices, or are any benefits offset by high input prices and crop losses from floods? It's open to the floor as far as I'm concerned.
I might start here and let Andrew finish this question a little bit. I think from a price point of view, obviously it's definitely much higher, but it depends if you've got any product. If you were a lettuce supplier out of Victoria, maybe you had a little bit less stock, but at least you had some. So I guess it depends on a regional scale. Where were you? How much of your crop was lost? Generally there are unfortunately people that you don't necessarily win each time that this happens, but you benefit from when you have product when other people don't. I think Andrew is probably in a slightly better position to talk about what those prices are. I know I've seen figures where production costs are up by really significant amounts, which would probably offset that anyway.
I feel like I'm going to give.
I was going to chime in and say surely it's better to have a trailer load of iceberg lettuces at $2 than only one pallet at $12 each. So I think it's a key sign that it's not benefiting industry.
I think I can give an answer that's quite similar to the last answer. I feel like I'm sitting on the fence a bit here, but it is a case of it depends on who you are and where you are. We've got high input costs. Basically, every input you can think of is expensive. So that's something that we're aware of. If I look at it from a grains point of view, which is my background, if you've produced something and you've not been flooded out, well, those higher commodity prices kind of take away the issue of the high input prices. But at the same time, if you've spent a fortune on inputs and you produce nothing, then that is the major issue that we see, is that we've got a cost price squeeze that is then exacerbated further by lack of production caused by, in this case this year, weather effects. And that's probably the same with vegetables, I would imagine. Same as what James was saying.
Just to carry on to the next question, to make sure we can get sort of through all of them without running too far over. This one dovetails nicely into another one for you, Andrew. Raw material costs for inputs seem to be falling now. Will this continue? Will this be reflected in the selling price we pay for crop inputs in Australia?
Okay, that's a good question, and it's probably a curly question. And the reality is that, yes, what we're seeing is input costs around the world are starting to decline. Freight is declining. Energy costs, some energy costs are declining depending on where you are in the world, which is a precursor for lower costs. It's also a precursor for potential global recession, which is not necessarily great for agriculture either. In terms of how quickly is that reflected within Australia, I will go back to the old saying, how long is a piece of string? Because what happens overseas, we can see fertilizer prices drop overseas and very little impact on the price in Australia. And that is a concern going forward, because we have transparency in every other market, but fertilizer prices. So the answer is yes. If the price for the raw materials that makes inputs decreases globally, yes, it will be flowing through to Australia. The question is, does it flow through in the time for it to be of any benefit to the Australian producer? That is the question. There is a long lag time between them. Diesel is actually generally about 2 weeks lag, but on other commodities, it can be 6 months lag.
Okay. One for James. Is the quantum of price inflation, interestingly worded, in wholesale and grocery channels being reflected at the farm gate? If not, why? Similar to the last question, I think.
Yes, can also be a bit of a curly question as well. I guess it comes down to realistically, there has been if anything, for the September quarter, more price inflation at wholesale than what you saw at retail, which probably wasn't the case earlier in the year. So I think there's pressure on retailers right now to not raise the price. As I sort of floated up with some of those news articles, the retailers want to be seen as, you know, good managers of, you know, basically they're Australian companies. They want to be perceived as good for Australians. They don't want to see prices over $15 where, you know, it gets negative attention for them. And I think there's going to be real pressure on them as well, with people looking for deals to keep prices down. So in some ways, you know, there might be some pressure there to reduce margin for retailers, because obviously those pressures are still there and on wholesale, but it really depends on what happens with supply. And realistically, as much as anything, that probably comes down to the weather. It really, I mean, we're so it's I'm not sure, Rachel, if you can tell anybody whether they're going to get washed out or not, but that's might leave that one to you.
I think we're probably getting close to having to call it for today, as we don't want to run too far over and people are starting to drop out. We've got another couple of questions here that I might take offline and get answers for separately. But I'd like to thank all of the presenters today for coming and sharing your insights and expertise with us. We will be distributing the links to download the presentations with the follow-up email generated by Zoom that you'll get. So keep an eye out for that and don't just bin it. And also we'll be hosting the recording with download links to the presentations on the AusVeg website and YouTube channel. If anybody who's left in the room, I should have done this slightly earlier, but if my colleague Greta, who has been incredibly helpful in the back end of running this webinar series, if Greta could launch the poll asking for some feedback on topics you're interested in and whether you've enjoyed today's seminar, that would be very useful for us in planning it. This is the annual Vegetable Industry Seminar Series is a 3-year program, and we'll be hoping to run more seminars next year, and we want as much feedback from industry as possible. So this is the final webinar in that series for 2022. This year's in-person seminars and webinars have been a huge success with record numbers of attendance. And today we had probably about 150, 160 people through, and about 135 at any one time, which is quite gratifying. Next year, we're planning on running more webinars, potentially running up to 6 or 9, depending on interest. And we'll be running our usual half-day in-person seminar in the middle of the year. That'll be held at the Adelaide Convention Centre on the 5th of June from 12 until 4 p.m. with a catered lunch. And anybody who's registered to attend for an AVIS event will get an invitation to this event in the future, including all the panelists if they feel like coming along. So I would like to thank everybody again for joining today. And yeah, that about does it. Thank you so much.
Thanks for having us.
Thank you.
All right.
Thanks.
I look forward to hearing more from everyone.
Cheers. All right. See you guys.